Welcome to the B.F. Anderson Technical Report for April the 29th. Look, the economy is running red hot. This is the U.S. Manufacturing PMI Index. This measures manufacturing activity. Now, what happens a lot of times when the market gets too hot, or the economy gets too hot, we go through a correction in the market. It's because of worries about the Federal Reserve and higher interest rates. So if you go back and look at the last times this has happened, back in 83, 84, which was really, if you remember your history here, that was a wonderful time to be investing in the stock market. Well, we had red hot PMI data. Now here we have, again, you can see where we got red hot. The market continued higher. And now we are red hot right now. So, if history repeats itself, it's just kind of hard to say. But once you get this hot, there could be a pullback. So just be aware of that. But it's the beginning of a new cycle. So you should be optimistic. Now, a lot of my friends and people that I talk to all the time are talking about Bitcoin. Now, I agree with Nassim Taleb, who is the author of The Black Swan. He's a very smart guy. Basically says this is a gimmick, it's a game, and it resembles a Ponzi scheme. And it really does. To me, it really does. So let's go ahead and just look at reality here for a minute. This is the real world. Here's the Nasdaq. You can see we're holding above the 10-day on a buy signal, very constructive. Nasdaq is improving greatly. Here we have the mid-cap stocks, same situation, kind of a gap up a little bit here, moving sideways for the last couple of days, but looks very positive. This is the New York Stock Exchange. Now remember, we look at 5 indexes. This is all the stocks on the New York Stock Exchange. Gosh, you just really can't ignore the fact that it's just a steady increase in trend. Now the only problem, again, I want to mention is volume is light. But, sometimes the market has a way of just sneaking up on you with light volume. Here's the small caps. Now, the small caps have really been kind of struggling a little bit, but I'm seeing some improvement there. Here's the actual S&P 500. Again, we can see the low volume, but again, very positive pattern, no problem whatsoever. Now, on the more intermediate term indicator, which is the Nasdaq. Now, we also look at the S&P, but I just basically have the Nasdaq here. But it's a weekly read, and we're looking at the 35-week moving average. If you break down below it here, which it did back in the with the coronavirus and so forth, but we have not. We're in an uptrend. This says we're in a bull market. Now, again, the Nasdaq, I've got the Nasdaq here, but I want to talk a little bit about one of our indicators that we're going to go into. Now, look, I'm introducing some new indicators this week because I went to an interview with a particular analyst who I have building some respect for. I'm not going to mention his name, but it's somebody that is making some sense to me. And so he introduced me to some new indicators, which we're going to talk about. But let's look at this one first. This is the aggression index. Now, what I did is I went back to 2012, and you can see up here I've got the Nasdaq. Now, what happens is with the aggression index, which what we're doing is we're doing a ratio here of the Nasdaq compared to the consumer staples. So we're comparing technology to soap. Okay, so in other words, aggressive versus defensive. So when this line is going up like this, that's what you call a growth stock cycle. And it's usually led by like a couple of companies. It won't be like 50 companies. It'll be 1 or 2 actually. I can remember NVIDIA was a big leader back here. Then the cycle ends because it just does. We go into what we call a consolidation phase, which we did between the year of 19 into 20. Then we started another growth stock cycle. Now this would be what I would call the Tesla cycle. This was, solar, electric cars, so forth and so on. In other words, this was a very powerful up cycle. So it would not surprise me if we just don't go into another consolidation phase, and then we've got to look for what is going to be the leadership in the next cycle. But anyway, I thought that was interesting. If you look at the correlation with the stock market, this is a very important ratio. So let's look at the actual indicator. Okay, you can see here we are seeing improvement here. This is on a daily basis. We peaked on February the 10th. Made a low, higher low, came down, made lower low, lower high, lower low, lower high, but now we're starting to make a higher high and a lower low. We're starting to develop an uptrend here. So I'm becoming more optimistic on the growth stocks. Now, if you think about it, the actual indicator, which is the 40-week moving average, we never broke it. Now, we did break it back here in the bear market caused by the pandemic, but we did not break it this time. So we basically came down and made a major V bottom, and now we're breaking out above that 10-week moving average. We've held the 40-week. This indicator is on a buy signal. Now, if we just look at things in general, this is Treasury notes. This is the 10-year Treasury note, 1.62, staying pretty steady. Oil is currently 63.64, holding steady. And the financial stocks are really starting to show some improvement here because interest rates are upticking. Now, on the new lows, kind of got a little bit of a worry here, but not much. I mean, we're in good shape here. This is not a problem. Now, this is one of the new indicators that we're going to introduce at this particular time. What we're looking at here is an inverted yield curve. Now, if you go back to 1900, the yield curve has correctly predicted recessions 100% of the time. So if you get an inverted yield curve, now what we have here is we're taking the 10-year Treasury yield and we're comparing it to the 3-month Treasury yield. And if that number goes negative, you're inverting. Well, you can see here we inverted back here in 07, early 08. Well, we know about the financial crisis. It predicted the recession. Now, if we go back here and look at this other time that we inverted back in mid-19, well, we went into a recession. So I think this is a very valuable indicator. I think we should keep an eye on it because it's just got such a strong track record, and it really makes a lot of sense. So if the yield curve inverts, what it means is that the big nasty is coming, which is the recession. This basically is saying right now, though, and this is where we are now, we're in an economic expansion. So I showed you earlier the PMI data. This is basically confirming that. The economy is pretty darn strong right now. Now, another indicator that we're going to introduce is the American Association of Individual Investors bullish percentage minus the American Association of Individual Investors bearish percentage. So they do a weekly survey. And so basically if the bulls are outnumbering the bears, you get a real positive number. If the bears are outnumbering the bulls, then you get a negative number. So you can see back here that market bottoms tend to be made. This is a contrarian indicator, but I think you should pay attention to it. It's a very important one. And it's basically saying right now what we're seeing with the, put-call ratio, same thing. We're seeing a lot of greed here. So it's making it where it's difficult to make money in the market because everyone's optimistic. Well, we'll see what happens. Now, another indicator, here's another one. Now, this is important. This is where I'm comparing junk bonds to Treasury bonds. So in other words, think about it. If you invest in a junk bond, your greatest concern is default. The company can't make the payments. So if you're worried about defaults on the junk bond market, you're basically worrying about a recession. So that's what we talked about with the inverted yield curve. This kind of goes hand in hand with that. So you can see here back in the last recession, this ratio, as long as this line is going up, it means that junk bonds are doing better than Treasury bonds, which means people have confidence. But if they start worrying about default, like right here, you go into recession. Well, you can see where we are right now. We're in a very positive uptrend. Again, we are in an economic expansion. This is a bull market. Make hay while the sun shines. Now, another indicator that we're going to introduce, I'm going to add Visa, the credit card company, stock price to our list of indicators. Now, why? Because the spending patterns of the millennials will be very important. In other words, the people aged between ages of 30 and 50 are going to drive the economy with spending. My wife's parents live in a nursing home. they don't spend money on anything. I mean, it's just they don't need to, so forth. As I've gotten older, I've noticed my spending patterns have changed. But when you're 30 years old and you're going towards your maximum salary, or your career is developing, you're buying houses, you're having children, you're spending money. So this comes up in the credit card transactions. So as long as Visa, we could use MasterCard, we could use American Express, it doesn't matter. Point is, this isn't a strong uptrend because it simply means that, the millennials are spending money. Now, volatility index, we continue to be low, very under control here. This is the most positive reading we've had, meaning overall, because we're just down here in this lower area. So things are really looking good there. Now, let's get into the top 5. Again, we're seeing a lot of energy stocks. I'm just simply saying we don't want to, it's hard to figure with energy, but energy is stabilizing in that $60 area, which I hear is critical. This is Cimarex Energy breaking out of a base, looks positive. Again, another type of an inflationary type of material would be aluminum. So you're seeing here Alcoa continues to stay on our list. We're not seeing a lot of technology here. Callon Petroleum, same thing. We're seeing the energy stocks continue to strengthen. FANG, which is Diamondback Energy, a great company out in West Texas, breaking out of a base here. This looks very positive. Novavax, now this is vaccines. This is one of the vaccine manufacturers, broke out, so we're seeing some activity there. So all in all, that's it. If you have any questions, please give me a call. Thank you very much.